Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 24th of February. I'm Daniel Lam, your host for the podcast. Once again, the gold chart caught my eye, especially in conjunction with the relative strength indicator, i.e. the RSI. Now, keen listeners of this podcast would know that I do not just look at the direction of an asset, but I also check how the strength of this asset has been evolving as well. Well, in this case, gold has been hitting highs, but its RSI has been slowly diminishing, indicating weakening strength to go higher. This, combined with gold being around its all-time high, means that a short-term correction is near. In our most recent podcast on gold, we talked about positions becoming quite crowded. The nominal net long exposure in gold futures, as well as the net number of discretionary traders holding long gold positions, is near historical highs. We also spoke about US-based discretionary institutional investors being a new force of buying demand in 2025. Unlike November and December last year, when US growth optimism and rising yields had some domestic investors trimming purchases of gold, the latest move has been a positive shift in appetite during the US hours. However, reported official sector buying has been slowing. Both India and China markets are trading at a discount and have entered a seasonally slow period for consumption. Tactical investors are cautiously adding to their short exposure, but more likely as price protection rather than taking a negative view on gold. The uncertain geopolitical and tariff backdrop has been a key factor supporting gold. However, the recent prospects of potential peace between Russia and Ukraine is a possible factor to drive down the geopolitical premium. So, should one expect large pullback in gold? Pullback, we believe, yes, but not massive. We see 2,800 as a good support level for gold. Now, exchange-traded products inflow have slowly turned positive, but greater demand may come from China, announcing a pilot program to allow 10 insurance companies to invest up to 1% of their assets in gold, estimated at 200 billion CNY, which is around 27 billion US dollar, or the equivalent of 300 tons. So this represents significant potential flow for the gold market. China's consumer demand fell by 10% in 2024 to 816 tons. At its peak, it reached 1,450 tons in 2013. Now, potential demand is around 1/3 of annual official sector demand over the past 3 years and would offset the equivalent of the exchange-traded product net redemptions over the same period. In China, gold has to be sourced through the Shanghai Gold Exchange, and the local discount has started to narrow over the past week. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.